Hello everyone, I welcome you to another video of this course. In this lesson, we will be learning about environmental sustainability and reporting. And under that, we will look at the various subtopics: environmental, social, and governance disclosures, carbon accounting basics, methodologies of carbon accounting, and regulatory trends. So we'll be looking at what is environmental and sustainability reporting. Environmental and sustainability reporting involves disclosing a company's non-financial performance, including its environmental, social, and governance efforts and impact. This reporting helps companies communicate their sustainability commitments and progress to stakeholders such as investors, customers, and employees. Sustainability reporting has no set format, but broadly, it involves disclosure of a company's environmental, social, and governance (ESG) goals and communicating the company's progress and efforts to reach these goals. Along with ESG initiatives, sustainability reporting includes financial statements. Sustainability reporting provides stakeholders, such as investors, valuable information about a company's performance beyond just traditional financial measures. A sustainability report is a report published by companies on the environmental, social, and governance impacts of their activities. It enables addressees and users to understand more clearly the impact of a company's business activities on the environment and society, and to assess the risks and opportunities companies face or which are offered to them. It is a communication tool that plays an important role in convincing special observers or skeptical observers that the company's actions are sincere. The growing importance of sustainability reports is due to the fact that investors and other stakeholders are calling on companies to disclose more information about their sustainability activities and environmental, social, and governance strategies. Now let us look at the key areas of environmental and sustainability reporting. As the name implies, the environment, the society, and government. Now for the environment, this includes reporting on carbon emissions, energy use, water consumption, waste management, and environmental impact. In respect to the society, it covers aspects like labor practices, diversity and inclusion, community engagement, and human rights. And on the part of governance, it involves reporting on company structure, board composition, ethics, and risk management. Now let's move on to carbon accounting. Carbon accounting is a way of calculating how much greenhouse gas an organization emits. Like financial accounting, carbon accounting quantifies the impact of an organization's business activities, though instead of financial impact, it tracks climate impact. Also known as greenhouse gas accounting, carbon accounting is used to estimate carbon footprints for businesses, governments, and even individuals. A famous management adage says that you cannot manage what you cannot measure. Likewise, carbon accounting helps organizations understand their carbon emissions so that they can identify hotspots, enabling them to begin their reduction efforts with high impact actions. And even when an organization has reduced its carbon as much as possible, calculating its carbon footprint will still help it estimate its residual emissions. The organization can then use climate investment to compensate for its remaining emissions, completing its journey to net zero. Along the way, organizations will want to share their progress with stakeholders like customers, investors, and employees, or they may even be required to report their emissions by law. Carbon accounting enables companies to report their climate impact. So let us look at the methodologies of carbon accounting. Carbon accounting calculates an organization's greenhouse gas emissions using two methodologies. And what are they? Spend-based methodology and activity-based methodology. The hybrid methodology combines spend-based and activity-based methods. So let's look at the spend-based method. The spend-based method of calculating greenhouse gas emissions takes the financial value of a purchased good or service and multiplies it by an emission factor, the amount of emissions produced per financial unit, resulting in an estimate of the emissions produced. The spend-based emission factors are typically derived from so-called environmentally extended input-output (EEIO). EEIO models that depict the flow of resources between different sectors of the economy. Based on this, one can calculate the average amount of emissions associated with each unit of the money paid to a company in some specific industries and regions. Since spend-based methods' emission factors are built on the industry average greenhouse gas emission levels, spend-based calculations can lack specificity. For example, if you buy a chair, a spend-based approach would only factor in that you bought a piece of furniture and wouldn't account for whether the chair was made of iron or wood. The activity-based method. The activity-based method uses data to specify how many units of a particular product or material that a company has purchased. For example, it could be liters of fuel, kilograms of textile, and so on. Like the spend-based method, the activity-based method also uses emissions factor to determine an activity's emissions output. These emissions factors are often taken from scientific studies. In carbon accounting, activity data generally allows for more accurate emissions estimates than spend-based data, but it is not as readily available as spend-based data and can be time-consuming to gather. Next, we'll be looking at the hybrid methodology. The hybrid model methodology is recommended by the Greenhouse Gas Protocol, the most widely used carbon calculation standard. Its pragmatic approach involves using all the activity-based data possible, then using spend-based methods to estimate the rest. Now, let us look at regulatory trends in the oil and gas industry. Regulatory trends in the oil and gas sector are evolving to address growing concerns about environmental sustainability, safety, and social responsibility. The key trends include stricter emission targets, enhanced safety protocols, and a greater focus on sustainable practices. These changes are impacting all segments of the industry, from upstream exploration and production to midstream transportation and downstream refining. So, what are these regulatory trends? We have environmental regulations, we have safety and security, we have environmental, social, and government criteria, we have deregulation and market liberalization, there is technological innovation, there is policy development, and there is also decommissioning, all of which are explained in detail in the course outline. And with that, we have come to the end of this course. Thank you for watching, and I will see you in another video. Bye for now.